Hi everyone. So this week I'd like to talk about an important psychological concept in trading options, and it has to do with your daily routine and expecting the unexpected. The fact is that when you wake up in the morning and you take a look at your futures market and you see the likely direction of the market open, it's important to remember that that's just the likely direction of the market open. And even then that can be wrong sometimes, but usually if the futures are up, the market will open up. How long it'll stay up is a major question, and you don't really know. You've got to observe. So you've got to plan for midday market reversals, and it's got to be in your thinking throughout the day. I can share with you my morning routine. When I first open up my computer, which is no later normally than 8:30 in the morning Eastern time, to give myself a full hour to kind of prepare if I need to, which I normally don't need that much time, but you never know. I take a look at lots of different things: the Dow, SPX, Russell, NDX futures. I look at oil futures. I look at treasury bond futures. I look at gold. I look at pre-market VIX trading. And I get a sense of sort of what's going on in the market from an options volatility and from a directional viewpoint. And that's obviously very important information, especially if some kind of a big move is going on or some kind of big news is going on. So then the next thing I do is I take a look at every trade that I've got on, and I write out. Sometimes it's tedious, but sometimes you have to do tedious things. I sit there and write out on a pad exactly what I will do on each trade in the event of a move up and a move down. I'll pick the price points that will affect when I will do things I need to do, adjustments, and I will pick those points to the upside as well as to the downside. I establish an upside plan and a downside plan for every single one of my trades every single day. If the plan involves a complex series of transactions, for example, let's say you are rolling your whole position up, and let's say you've got a lot of moving parts in your position, you may actually have to plan out in detail the way that you're going to transition your trade from one part of the market to another. There are cases where I've spent 30 to 45 minutes planning out how I'm going to move a position. There's a lot of implications. We could talk about that another time of how to do this in a way that's safe, but to do things safely and carefully, it can take some planning to do so. So I've shown here on the screen an example of some order tickets that I've set up today for a potential trade I may or may not have to make by the end of the day on one of my positions. And as you can see, it gets a little complicated, and I've had a lot more than 4 open tickets ready to be fired off in the event of a complex order, a complex restructuring of a trade. So I always plan for large up and down moves. Now, why is it so critical? Why do I emphasize so much you're planning this? One of the reasons is obvious. The other one's really important, but maybe not so obvious. The obvious reason is if you're not prepared, you're going to be scrambling if something unexpected happens. Well, scrambling's never good when you're trading for a lot of reasons. You make mistakes, you get nervous, you panic and you overpay for things. When you're not ready to fire off the orders that need to be fired off in a calm and deliberate way, you are going to suffer, almost no question about that. And some of the biggest losses are taken when people are not prepared. So that's a very big and kind of obvious reason. The second one, though, is really why I'm giving you this talk today. And that is the very act of planning for a move in the market going both ways psychologically prepares you for the fact that it can go both ways. If you open up your computer and the ES futures are up 20 points, you're going to see that. Anyone normal human will see that as an up day, a big move up, right? But the fact is that that big move up, if it occurs, because if you're starting at 8:30, by 9:30 it could be up 2 points or it could be down 2 points. But if that maintains itself, that may not maintain itself for long. You could have the market rally in the first 30 minutes and then sell off dramatically for the rest of the day. And I have seen that happen. I've also seen the market sell off dramatically and then midday, later than midday, 2:30 in the afternoon, it goes on a rally that can be stunning. And so you do not know, because 8:30 in the morning the futures are in a certain direction, that is particularly predictive of what's going to be the case by the end of the day. You simply don't know. And if you don't believe me, think about what happened on election night last year, when initially, when it became apparent Trump was going to win, the world market started crashing, and then by the end of the next day the market had started a dramatic rally which went on for over a month. So you have to be psychologically prepared for the market to move in either direction. Now, why is that psychological preparation so important? This is what is the subtlety I'm trying to bring out today. If you have a belief that the market's going up, it's just going up. Why? Because it's going up right now, so I assume it's going to keep going up. That's called continuation bias. All right? Well, the problem with that is that then creates a tendency in people to get ahead of the market. Well, I know it's going to go up to resistance. I know it's going to go up another 5 points. So the adjustment that I need to do in 5 points, I might as well do it now and save some money. The problem is there is no law that says it has to continue for those additional 5 points. And if your adjustment was dependent upon those 5 points happening, and you adjusted, and then the market reversed, you now have paid for an adjustment you didn't need. And that can be very frustrating and very painful financially. Because you, however, if you have prepared for the market and you go through the act of preparing for the downside in that scenario, then you have in your consciousness the possibility of the downside. Therefore, you're much more likely to not pull the trigger early on an adjustment, not give in to your continuation bias, but instead wait calmly for the market to play itself out. Your adjustment point may or may not be hit. You don't know that just because it looks like it's in the direction of getting hit. You do not know that. You should not do adjustments that are unnecessary. If you have planned for a market reversal, you're psychologically less likely to do that adjustment prematurely because you've thought through, okay, if the market goes down, what am I going to need to do? Well, that means you've got to take that possibility seriously. If you take it seriously, it prepares you psychologically for that market reversal. So, in summary, be prepared before the market opens for both an upside and a downside move. For one thing, because you got to be prepared for unexpected things to happen, but just as importantly, you have to prepare yourself psychologically to not jump the gun on your system, to not jump the gun on your protocols. Let the market play out. You really don't know what's going to happen next, and therefore don't put yourself in a psychological position that's going to cause you to make mistakes. So please plan ahead, think through seriously a downside move on an up day and an upside move on a down day. If you do that, you'll save yourself a lot of money in adjustments that you should never have made. Thanks very much, and we'll see you next week.